Okay, so obviously we're coming to at a very peculiar juncture for the Irish economy. You know, we had one of the most prolonged, one of the stricter lockdowns from the April through to June period relative to other countries, other European peers. Yet our GDP outturn was much more benign than we had expected in our previous analysis, and that's despite record unemployment rates, record drops in consumer spending, and a very challenging operating environment for the domestic economy. So that's the kind of frame and context for the work we're going to be presenting today. Over and above that, the Irish economy is kind of facing down the barrel of two major challenges next year. One is obviously the ongoing public health restrictions related to COVID-19. And the second one is the major risk of a no-deal Brexit, whereby we're moving into January 2021 with the possibility of WTO-type tariffs in the relationship between the UK and the EU trading activities. So very challenging period with big differences in the economic situation, and particularly the duality of the Irish economy is quite stark. So we're going to talk through that today. So just to kind of give you a short overview, it's very clear that the domestic economy is continuing to struggle with the impact of COVID-19. The unemployment rate was nearly 15% in September, the COVID adjusted unemployment rate, and that's up dramatically on the pre-pandemic period. And now it has come down since the April highs of nearly 30%, but it is still a severely elevated unemployment rate, and the economic well-being hit particular for younger households, for those who were previously employed in accommodation and food services and domestic oriented sectors, has been quite dramatic. But then we get this major significant variation across the sectoral hit. The manufacturing sector, in particular driven by medicinal and pharmaceutical activities, has been growing quite rapidly. But then you've got other sectors whose operating activities really are struggling to be consistent with an environment which has ongoing public health restrictions. And we can see distribution, transport, arts, entertainment, these sectors have had major declines. Overall, though, relative to where we thought we would be at this time, the impact on GDP, the headline GDP, is less than expected, and that has been driven mainly by the very robust export performance. And many of you may have seen the research note we put out, trying to provide a little bit more context for that today. The consumption falls and the modified investment falls have been quite dramatic. Overall, for the headline, we're looking at a GDP drop of about just under 2%, so 1.8% this year, and then moving into next year, as I mentioned, facing those two major challenges. One being the ongoing public health restrictions, secondly being the state of the Brexit relationship that occurs afterwards. We kind of have two benchmark scenarios. If there's a free trade agreement for next year, even with the public health restrictions, we would see quite robust growth next year, about 6.5%. But in the context of a no-deal Brexit, where there will be WTO-style relationships, that growth will be halved, nearly about 3.3%. So we'll talk through those in a little bit more detail in the coming slides. Okay, so to just give a little bit more granularity, if this table gives our summary headline findings. Again, looking down through the 2020 figures, we can see the duality of the economic impact is very stark. You see private consumption is down just over 9%. We're expecting for this year. Big increases in government spending, up nearly 10% this year, and major drops in investment of nearly 17% in 2020. Contrast that with the export performance. The fact that our exports are concentrated in these lockdown resilient type sectors, in particular pharmaceutical activities, in particular computer services activities. It looks like that we may even have some export growth this year, even though many export sectors have had major declines in activity. The big ones that we we're highly concentrated in, and that are areas of particular specialization for us, appear to be growing quite strongly, and that leads us to having a much more benign GDP outturn relative to what we were previously discussing. In terms of next year, even our baseline forecast assumes a free trade arrangement with the UK, but it also encapsulates some level of ongoing public health restrictions throughout the year. In that context, we do still see a pickup in private consumption expenditure of about 5%, and that is obviously on the back of a major decline this year. In terms of investment, we see quite a strong pickup again next year, but again, that is because one of the reasons behind that is the major drop this year, and we see the strong pickup in exports next year, leading to about 6.5% increase in GDP. The unemployment rate for this year, for the full year, we're expecting it to be just under 17%, which is a major increase on last year. And we see it, under our kind of baseline ongoing public health restrictions, but with the WTO, with the free trade style arrangement between the UK and the EU, we see it coming down next year to just under 10%. Still, very, very elevated, but down on this year. Okay, we thought that we'd put in this chart to just kind of give quite a stark contrast between what's happened across the Irish economy. What this chart shows is the Irish year-on-year growth for the second quarter of 2020, so the kind of lockdown phase. Ireland is the light blue color, and then the average for the EU 27 is the blue, the darker blue, and this splits it out by the various different sectors. The names are written underneath for where we've used initials. But you can see the industrial activity driven by the pharmaceutical sector has had a major dramatic rise in the second quarter of this year, whereas many of our more domestic facing sectors, in particular arts, entertainment, recreation, the professional services, and the wholesale retail, the wholesale retail, accommodation, and food, they've had a bigger shock than the EU average, and this really highlights the duality of the economic impact. Following through to that, you can see that its household spending has come down quite considerably. When you look cumulatively across the first half of 2020, the shock in Ireland has been one of the biggest across the European Union. There has been some pickup. You can see some of the more real-time indicators, the consumer sentiment and the retail sales. They have picked up in the period July, August, and even into September. And that does suggest there is a bounce back in consumption, which has led us to pare back the fall that we had expected in May, in our May QEC, but still it's a big decline in consumption. And obviously there's quite a lot of debate about the extent to which we're going to need further restrictions from now until the end of the year. And naturally, if we're in a more restricted public health type arrangement, that will lead to lower consumption for the fourth quarter. Yeah, this chart, it clearly shows consumer sentiment. We can see Ireland in the green had a bigger drop in consumer sentiment than other countries, but there has been a rise commensurate with the reopening phase and through the summer months, which is a positive development in terms of the recovery over the summer period. In terms of investment, obviously the investment, when businesses are making decisions around trying to commit capital that they will need to operate for the coming years, uncertainty and the degree to which they can ensure that, or feel sure that they will have they will be able to operate and use those assets. In the current environment, it's very difficult to see businesses doing that. So the degree of uncertainty is a big determinant of investment, and we can see there has been a big decline, a very, very strong decline in modified investment activity in Ireland, and we would see that being one of the biggest declines in all of the expenditure items this year. There has been some more positive news, the most recent CSO impact surveys where they look at how many businesses are currently operating and trading, that does give, through the summer months, there was a pickup in that, and there was definitely a small rebound, but still the outlook is so uncertain that it's hard to see investment bouncing back in any huge manner while we have the current uncertainties. At this stage, I'll just hand over to Kieran to talk a little bit more about the trading activity.
Thanks. Thanks, Conor. And good morning to everybody. Just to say as well that our colleagues Adele Bergin and Abian Garcia Rodriguez are joining us as well for this presentation. And indeed, Adele will go into some of the Brexit issues in terms of they've done a box in the commentary on a nice box which uses the macroeconometric model Cosmo, and that model is used to look at more longer term issues, if you like, in terms of some of the recovery paths, potential alternative recovery paths around COVID. But also it goes into the Brexit issue in terms of looking at the impacts on the economy of a no-deal Brexit, as well as the COVID scenario, so some certain COVID scenarios. So Adele will talk about those boxes or talk about that analysis in a minute. So in terms of the trade, obviously there's been a very substantial variation, as Conor said, in terms of the dual economy issue. We see significant variation across the different sectors generally in the economy, and there's no more clear evidence of that than in terms of the overall effect on the traded sector. And indeed, Conor himself has brought out a research note this morning which goes into this issue in quite a bit of detail. So I won't dwell on it here in terms of the overall composition of exports. So we've seen an increase in exports year on year between Q2 of 2019 and Q2 of the present year, which was, quite remarkable really when you look at the overall global situation and the downturn in global trade. But significant rallying by certain sectors, particularly the pharmaceutical sectors and medicinal exports, registered strong growth, and that tended, if you like, to bring up the overall export picture as a whole. Imports obviously declined, which was related to consumption and investment. But the strong performance of the export sector did result in some, in boosting imports of certain goods and services that were used in the production of those exported goods. So if you go on to the next slide, you can see exports by component and commodity groups. So you can see the performance of medicinal and pharmaceutical products, organic chemicals, computer services, etc. So, again, quite remarkable that these registered actual year-on-year growth, even in the midst of the COVID downturn in Q2. The following slide just summarizes the box that was released today. Again, I won't go into it in much detail, but again, I suppose the crucial point is that whilst the overall impact on GDP in an Irish context is quite mute compared with other countries, that ultimately is down to the very strong performance of certain elements within the export sector. And it's a relatively small number of firms within the export sector that are causing this very sharp increase in exports, industrial output. And that ultimately is giving, if you like, this overall picture of a relatively benign impact on GDP. Whereas, when you dig beneath the surface and you look at investment consumption, you're looking at very substantial falls, particularly when compared with other benchmarked against other European countries. And obviously then the resulting and associated very sharp increases in unemployment. So in terms of the labour market, you can see our overall picture for the year is that unemployment will be just under 17%. Next year, we believe that will come down to just under 10%. If you look at where the unemployment situation is right now in September, it's just under 15%. That's down from 30% in April. Obviously, the very, very sharp increase in unemployment, as a result of the lockdown and the measures associated with that. Again, significant variation in the impact of the pandemic across sectors. And we present quite a detailed breakdown in terms of the number of people both on the PUP and the TWSS throughout the period. And indeed, we go on to show that in a subsequent graph. So they're just looking at the numbers there. You can see in July, you can see that 84% of people, employees in the accommodation and food services activities, were on either the PUP or the wage subsidy scheme. It was 36% in construction, and then a relatively small number by comparison in the ICT sector at 15%. So the unemployment rate then, if we just move on to the graph, you can see this graph has been produced and people will have seen it used quite often by many different commentators in terms of its capturing the sheer scale and both the rapidity and the scale of the increase in unemployment during Q2. Again, you can see the unemployment rate has come down from 30%, down to around less than 15% at the present time. The subsequent graph is a nice graph done by our colleague Cathal Coffey, looking at tracking through time. So you can see from the 22nd of March through up until around the midpoint of September, you can see it tracks the numbers of people both on the PUP and those supported by the wage subsidy scheme, and then the traditional estimate of unemployment, the live register there, the kind of the light brown line at the bottom. So you can see the sheer numbers of people on the pandemic payment, maxing out at around 600,000 in early May, and then it's been falling thereafter. The vertical lines in the graph there, the red, the green, and the blue, are the various different points in terms of the roadmap. So phase 1, phase 2, and phase 3. So you can see just how that unemployment and the overall, if you like, composition of the different support schemes there, the numbers involved, if you like, as we track through from late March through to the present point in time. Going on to the public finances, I think that there's a very interesting overlap between developments in the public finances and developments in the labour market, and we comment on that in the commentary. There's many obviously standout figures and standout stylized facts from the crisis, but one which really did, I suppose, strike home for ourselves was this idea that unemployment could go up to 30% from around 4.5% in early February, go up to 30% in April, come back down to 15%, and yet the income tax take for the year to the present fell by just 2%. And I think that really gives a very, significant, we've always known of the various differences across the Irish labour market in terms of the nature of the employment and the nature of jobs, but I think it really does bear out the impact of the COVID shock. It has been, in the main, it has been in sectors where you've had people who are on, relatively lower wages, part-time hours, and so therefore, even though an awful lot of these people were made unemployed, the overall impact actually on the income tax take wasn't as significant as what you would have felt. I mean, if you had told anybody at the start of the year that unemployment would go to 30%, I think most people would have felt that the income tax situation would have been far more adversely impacted than what it was. So it really does point to the very significant variations across the Irish labour market and the associated kind of public finance situation to do with that. Clearly, obviously, you're going to see a deterioration, substantial deterioration of public finances this year and into next year. So our belief is that you'll have a deficit of somewhere in the region of around 25 billion, or just over nearly 7.5% of GDP the present year. We believe next year you'll have a deficit of somewhere in the region of around 15 billion, just under 4%. However, that is under the assumption that the support payments will be kept in place until April. Obviously, depending on the virus and the scale of it and the response of the public authorities, the support payments may last beyond April, in which case that would have obvious negative implications for the deficit and the debt. This year has been, there's been a number of surprises on the income, on the taxation side. So clearly, we talked about the income tax and how, relatively resilient it has been to the changes in the labour market. Obviously, other tax items such as VAT, excise, customs have all fallen very, very sharply. Corporation taxes, though, are still registering very, very strong growth, as it has been the case over the last number of years. So for the year to September, they're up by 25% compared to last year. And last year, they were up substantially on the year before, and again on the year before that. So corporation taxes have been rising very, very sharply. We've talked about this in other commentaries. But just to put it in context, if corporation taxes had grown in the present year by what people expected them to grow by at the start, so namely in line with, say, with the Department of Finance's forecasts, the deficit would be approximately 2 billion worse than what it is. Okay, so we've essentially had a 2 billion windfall from corporation taxes this year, and that results in the deficit being less than what it otherwise would be. So just again to put it in context, going forward, I mean, again, we've talked, about we can't really rely on continued substantial increases in corporation taxes. We have to treat some element of the increase as windfall in nature. And clearly there have been some developments, even, the ending of the double Irish tax arrangement this year, which may have implications for corporation taxes going forward. We don't fully know that for sure, but again, there has to be some expectation that it will have some adverse impact on corporation tax receipts. So for instance, in our forecast for next year, we actually forecast a 0 growth rate for corporation taxes relative to this year. Obviously, expenditure is going to be high or remain high, and that consequently is the reason why the associated reason as to why you have such a large increase in the deficit. So I'll hand over to Adele now, who will talk about the analysis that herself and Abian did in relation to Cosmo, and both in terms of analysing some COVID scenarios, but also in terms of analysing as well the effect of Brexit.
Okay, thanks, Kieran. So as Kieran and Conor have already highlighted, the economic outlook for Ireland is uncertain. And so in a box in the commentary, we explore the macroeconomic impact of COVID-19, the additional impact of a hard Brexit relative to a free trade agreement being agreed between the UK and EU before the end of the year. And we also look at possible recovery paths for the economy. So looking first at the impact of COVID-19, the pandemic is affecting the economy through lower consumption, employment, investment, temporary closures and restrictions that are affecting output in some sectors, and weaker international growth. So what we tried to do was to replicate all of these economic shocks in our macro model Cosmo, and to then examine a series of alternative adjustment paths for the economy. So we look at scenarios that differ in terms of the timing of the recovery. So we call these recovery and delayed recovery scenarios. We also consider a second wave scenario where there is another wave of the virus in Q4 of this year, and the economic impact of which is around 3/4 of the shock that we observed in Q2. And our delayed recovery and second wave scenarios also incorporate some scarring effects, whereby some of the losses in output and employment in the domestic kind of non-traded sectors are permanent. So all of our results are measured relative to a no pandemic baseline. So this is relative to how the economy would have performed had there been no pandemic. So compared to the no pandemic baseline, our results suggest a strong reduction in output in 2020 of around 7% in the recovery scenario, 8% in our second wave scenario, and around 9.5% in the delayed recovery scenario. Just over the sort of medium term then, in our recovery scenario, output returns to baseline, where it otherwise would have been in the absence of the pandemic by the middle of 2023. And in the other scenarios, output largely recovers after another couple of years, although it remains below baseline over the medium term. So our no pandemic baseline assumes a free trade agreement between the UK and EU starting in 2021. And obviously any recovery from the pandemic could also be influenced by Brexit related events, in particular the prospect of a hard Brexit where WTO tariff arrangements would apply, there would be non-tariff measures and so on. So to get at this, we leverage off previous research that examined the potential effects of different types of Brexit. And in interacting those with our COVID-19 scenario, draw on some work recently done by one of our colleagues, Martina Lawless, Daly and Lawless, which finds that there's actually limited overlap in the sectors that are exposed to the different shocks. So when we think about Brexit, we tend to think of it as a permanent shock that will reduce the level of output in the economy over the longer term. But Brexit has very uncertain short-run impacts. So we look at two hard Brexit scenarios which have similar long-run impacts but which differ in the short run, and we interact these with our recovery scenario. So the simulation results are shown in the graph. So we first show the recovery scenario and then the impact on GDP when we interact the recovery scenario with our two Brexit scenarios. So in a disorderly Brexit scenario, there are additional negative effects in the short run, driven by factors that are really hard to quantify, but we're trying to get at the sense that there could be disruption at ports and airports in terms of dealing with new customer requirements and so on. While in the other no deal scenario, there's a more smooth adjustment over the medium to long run. But overall, we find that a hard Brexit suggests a further loss of around 2% of output. Again, just to be clear, this is relative to the situation of a free trade agreement, which we had been assuming. So in the absence of a free trade agreement, we would expect over the long run output to fall by the level of GDP to be around 2% lower, while a more disorderly Brexit could also have significant short-term effects. And just linking it back then to the commentary, I think, as Conor outlined, the QEC forecast for 2021 is almost halved when you take into account the sort of the potential impact that Brexit could have. I think Kieran is up next.
Yeah, thanks very much, Adele. As Adele says, we draw very heavily then from that analysis in terms of our outlook for next year, in terms of the two different growth rates that we published today. Just one other box in the commentary box that I did myself, just looking at the treatment of intellectual property. This follows on analysis by an economist in the US, Brand Setzer, who's blogged quite a bit about taxation issues and the distortionary implications of certain taxation issues in terms of national accounts. And I think it's just an interesting note in terms of pointing out the impact that some of these issues are having, not just on Irish national accounting data. We've obviously known for quite some time that certain multinational related transactions are having quite significant distortionary impacts on our national accounts. We all remember the growth rate of whatever it was, 26% back in 2015. However, the analysis shows here is that this is also having a distortionary impact on euro area data. So not just domestic national accounts data. And it looks at the treatment of investment in intellectual property in the Dutch and Irish jurisdictions. You can see the very pronounced increases in the investment levels in 2015 in the Netherlands case, and in 2017 in our own case. And the top graph there just graphs that as a percentage of euro area GDP. So again, it's a non-trivial impact, if you like, in terms of its overall its impact on overall euro area GDP. And again, the graph below that then just traces through the impact on net trade and the contribution of net trade to euro area GDP, both with and without those transactions, or the with and without the Irish and Dutch data included, if you like. So you can get an idea of the impact that it has in terms of, you can see the way the data bounces around a lot more when you have the Irish and Dutch data included compared to when you exclude that data. The point here is, of course, this is important, if you like, for no other reason than the monetary policy reason. Obviously, monetary policy at the euro area is framed in the context of euro area GDP. And so when you begin to have or witness that some of these transactions are having an impact on GDP or euro area GDP, potentially can have an impact on the whole monetary policy transmission mechanism. So I think that is an important point. But I do think it also underscores, I mean, this doesn't conclusively prove anything in terms of, I suppose, the behavior of multinationals, but it does, I think, point to the fact that, tax authorities here in Ireland in this jurisdiction, going forward, we need to be cognizant and aware and ensure that any tax arrangements we enter into do not facilitate the kind of large scale tax avoidance which could, cause difficulties for us, particularly in terms of the attention that our taxation system tends to get at a European level. And that's particularly the case, I suppose, in a post-Brexit world where the UK would have had relatively similar attitudes and views to taxation issues as ourselves, particularly in relation to corporation taxes. And without the UK, in Europe, in the EU, it means that, you know, these issues will come under far greater scrutiny. The last slide just there, we try to, in the context of the deterioration, I suppose, more recently in the numbers in terms of from the medical perspective, what we've done here is simply reproduced some of the scenario results that we had in our previous commentary, which looked at the possibility of a further second lockdown in Q4. So if you go back to the spring or the summer commentary, we outlined a series of scenarios in terms of the impact on the domestic economy. One such scenario was of a second lockdown, an April-style second lockdown lasting for the entirety of Q4, and the impact that would have. And you can see, if you look in the baseline situation, you can see that consumption, for example, is down around 9% this year, investment is down 17%, and government spending is up 10%. If we were to have a second lockdown for the duration of Q4, you could see that the effect on consumption would be greater. Consumption would now fall by 16%, investment would fall by just under 30%, and government expenditure would be up by 14%. So that, if you like, the differential between those two gives you an impact, some idea of the impact of a second lockdown if it were to occur in Q4 in terms of the overall impact. Now, as to how overall GDP would be impacted, it's very difficult to tell because clearly it would depend on the performance of the export sector, but certainly the domestic sources of demand, consumption and investment will be quite significantly impacted if a further lockdown, full lockdown were to occur in Q4. So then to conclude, overall then, in terms of our overall assessment, you can see that while the decline in GDP is relatively limited compared to other European countries, you can see that there's very substantial variations across the economy in terms of the impact of COVID-19. So certain sectors have been decimated, very sharp increases in unemployment in those sectors. Other sectors, some sectors have done reasonably well in terms of the export, certain aspects of the export sector. Other sectors, again, public service being an obvious case, have remained relatively unaffected or impacted by COVID-19. Our overall policy prescription is that the support measures that have been outlined should be very much kept in place. There will be a need at some stage in the future to taper those policy measures, particularly, I suppose, in terms of the supports for SME firms. But we still believe that those support measures need to be kept in place. And we think that, you know, despite the fact that there has been substantial increases in both the debt and the deficit, we believe that over the medium term, the Irish economy is probably better placed to deal with those heightened levels of debt than most other European economies. I think we can, you know, fairly confidently predict that the economy, once the virus has abated and the impact has if you like, has ceased to occur, that, you know, the Irish economy will go back to experiencing relatively robust rates of growth over the medium term, and that will lead us to be in a better position to deal with the higher levels of debt, which we will certainly accumulate because of COVID-19. So that's the overall presentation.